Welcome back. It's time now for Hot Picks. Our next guest covers the financial sector. He sees opportunities in U.S. financials. Goldman Sachs is one of those picks. Let's bring in Julien Nono-Womdim. He's Vice President of Equity Analysis at Goodreid Investment Counsel. Julien, thanks for being here.
Thank you for having me.
Let's just jump right in. Goldman Sachs, one of the heavyweights of the U.S. financial sector, a huge investment banker, a huge capital markets trader. Why do you like this stock right now?
Absolutely, and of course the company needs no introduction. 2/3 of the business, of course, are capital markets and investment banking. The other third is wealth management. On the former, what we like about it is that trading activity has been elevated recently. In many respects, it reminds me a little bit of my childhood. I liked roller coasters.
Yeah.
Never really understood why people are afraid of them. They're generally safe. But the ups and downs are part of the thrill, and the market volatility, on the one hand, has made some investors fearful, but we've seen that as a source of opportunity. In Goldman's case, they benefit from volatility, more trading activity. And on the other hand, wealth management, equity markets are still near all-time highs, and so that bodes well for their fee income on the wealth management side.
Isn't volatility difficult to predict in at least two ways? A, we don't know when volatility is coming. We don't know if the second half of this year is going to be volatile or not. And secondly, isn't it difficult to predict the kind of profit that a big banker like this will make in a particular quarter from volatility?
In a particular quarter, it's very hard to predict, you're right, but I think that there's a lasting effect with trading activity. Even as volatility subsides, trading volumes tend to remain elevated. So that's number one. Number two, the company has been an exceptional operator. And lastly, as I said, the wealth management piece, which is vital to the company, benefits from higher asset prices, and that's what we've seen. And I think there's no reason to believe that equities don't continue to chug along.
Okay. Number two is a lesser-known company, StoneX Group, ticker symbol SNEX. Tell us about StoneX.
Well, similar idea. I'd say StoneX, there are three drivers to the business. The first is risk management and hedging for medium-sized businesses, alongside commodities, interest rates, and things of that nature. The second part is trading as well for institutional and retail investors, and the company has a small payment segment. Going back to the theme of higher volatility in the first half, and while that may subside, we're of the view that trading activity is going to remain elevated. The geopolitical risks we've seen, certainly in the Middle East and elsewhere, a bigger emphasis on hedging. And so we think that bodes well for the company in the near term. Longer term, what's good about StoneX is they've been a consolidator of smaller trading houses in the U.S. Think about the businesses that the larger peers like Goldman won't go after. They do well in that smaller pocket. They've been a consolidator for 20 years domestically in the U.S. Over the next years, they're increasingly exploring international merger and acquisition opportunities, and so we like it. Okay,
we've got just over 60 seconds left for Piper Sandler. This is an M&A specialist, and you like its positioning in that market.
Absolutely. The volatility we've seen in the first half has impaired deal activity, and the deals we've seen have predominantly been in large companies. In the back half of the year and into next year, we should see a sustained recovery in deal activity, and some of that deal activity is going to percolate to the smaller deals where Piper does extremely well.